All right, I'm here with Sam from All Star Charts. Sam, I came across his work kind of recently. I saw a bunch of very interesting charts that he was posting, and I was like, "Damn, this! I'd like to talk to this guy." Because basically, when you're looking at markets, it's kind of tough to understand the intermarket analysis aspect of it, especially when it comes to commodities. You don't see many people talking about it. You don't see many people interested in it. However, it's incredibly important. And so, just talking to Sam, I was like, "Hey, Sam, would you come on the show? Get your ideas, kind of put it out there, see what you're thinking." And so I got Sam on here. So Sam, a little bit about yourself. How did you get into markets? How did you get into commodities, especially?
Yeah, so my brother really turned me on to the markets. He was studying economics, and he he actually showed me JC's Twitter, and that's really my first introduction into the markets. He made it very simple for me, and it made sense. Um, and it's not just he really engraved the concept in me that markets don't exist in a vacuum. Everything's related to each other. And I'm from Kansas, and my mom's side of the family all farms. So
Oh, nice.
I've always been interested in what makes the grain markets move and whatnot. And yeah, I've learned a lot. My last semester, Wichita State, I just graduated a few weeks ago. I took a
Congratulations.
thank you. I took a commodities trading class, and Coke Industries, like the Charles Coke, not Coca-Cola.
Mhm.
They came to our class every week, just different traders, and they mainly focus on uh, energy products. Um, and they don't just do like oil and gas, but they do the byproducts that aren't publicly traded, and there's not really a market for that, so they have to make it. And like I said, markets don't exist in a vacuum. They're kind of basing it off of the publicly traded markets.
Nice.
They do a lot of intermarket analysis, like they're looking at the relationship between crude oil, heating oil, every single day, and how different reports affect that relationship.
I think that's incredibly important is just in general when you're talking about markets, the how things work with each other and against each other. That's kind of the most important thing that you'll kind of come to learn as you study markets over time is the like the when you're looking at the refiners, you're looking at gasoline, you're looking at heating oil and how the underlying meaning oil works with it. And then you and that's why I always tell people when I had somebody kind of write me and like, it's cool what you do, but I'm not into commodities, and it's like commodities are everything. If you don't understand commodities, you don't understand business. For example, as you know, you're farming. Obviously, everybody knows farmers deal with commodities, but if you're also talking about McDonald's, even McDonald's has to deal with cattle. They buy cattle futures, they hedge with cattle futures. This actually happened. It's kind of interesting to talk about this now, considering where we're at in the economic cycle. But if you go back to the McDonald's era, if you go all the way back to McDonald's in the 70s, they're at their highest point, but they're also dealing with this crazy inflation that's coming in. Now, all the companies right now, everybody's going, look, record profits. And like that is a thing. But now you also have to think about what exactly does that mean if they're spending a record amount of money too. So it's the same thing with McDonald's back then. They're spending a record amount of money. Their price is increasing every single day. They can't keep up with that. So, for example, if you have something like if you have a hamburger and you have cattle prices going up every single day, you cannot just change your dollar hamburger all the way to $2 to $3 to $4. Nobody will buy it anymore. So they might be able to get away with, hey, we've increased it to $1.50 to $2, maybe 100%. That's still big, but if your product goes up 300, 400% in cost, yes, maybe you've made another 100% that year, but you've lost money at the same time. And so it's a thing that most people don't take into consideration is that one, commodities are everything, and all the big companies that you're thinking about use futures usually to hedge their products. Things like corn, like that. That's why these markets were created. They weren't created for people like me to start funds and make money. They were created for farmers to be able to hedge their products, meaning as prices are going up, they're, and I'm all just explaining that to the general audience. As prices are going up, you are basically able to lock in your costs. So if you buy it here and let's say your cost continues up, you're kind of locking that in, and vice versa. You could be short because and most of the time you'll see this in a lot of the gold producers. Gold producers are almost always short gold because that's what they produce. So they're producing gold all the time. So they're short gold all the time. So when you're looking at that and you're going, okay, why are they short of gold all the time? Well, it's because they create so much of that product and they have so much gold, and that's how they make their money. So by hedging themselves, by looking for the downside in gold, they can make money in any type of environment. So I think things like that are incredibly important and something you just learn, especially like, you have family in the industry. Once you have family in the industry, like you can have those general conversations, but most people don't get those general conversations.
Definitely, yeah. The input costs are a big thing too. Like
Yes.
like they're always complaining about fertilizer prices going up,
Fertilizer prices.
and it's going up more than what the grain price is going up. It's cutting into their profit margins.
Yeah.
You see that in the feedlot operators. The grains they're buying to feed their cattle are going up more than the price of the cattle, cutting into their profit margins.
Exactly. And so that's another intermarket relationship that's also interesting to talk about, which is, corn to cattle. Corn to cattle. People don't understand how inversely correlated that is all the time. Like there's entire funds that are literally built to trade that. That's it. They just trade that inverse correlation, short term, long term, whatever. It's very highly correlated. Meaning, what we're meaning by that is if corn prices are moving up, most of the time cattle prices are moving down and vice versa. And it's not a perfect correlation. There's no such thing as a perfect correlation. But at the same time, you do get to see that there's a very tight correlation there. So most of the time, if you want to take a 3-month trade and you catch live cattle, let's say right now, cattle has been in an uptrend for a long time. Corn has been in a downtrend for a long time. If you expect that to change, you would bet the other direction. So you could start to go, okay, well, I do think this is going to change for these reasons. But right now, the trends don't say that. We're kind of at a point now where it looks like some of these things are bottoming. We're starting to get some signals in things like corn, soybeans, soybean meal even. But also, there's so much pressure on it from the cattle market. It's insane. And also something that's interesting is people keep talking about the bird flu and how it's decimating cattle. And they keep getting into this bird flu, decimating cattle, bird flu. And then if you look at the actual numbers, it's quite different. Kevin and I actually went over that on Monday, if any of you guys want to check that out. But we definitely went over that just to kind of talk about it. It was quite interesting because really that's the thing about all of these markets is you really have to kind of know them inside and out, not take the news for what it is. The news is shit. And the price action is the truth. So if you can kind of put those two things together, that's a way to make money in these markets. So you brought a lot of charts today. So I'd like to go over some of those because that's the thing that I think is really cool about what you bring to the table is just some interesting charts, some interesting intermarket signals that are just much different than what most people would look at. So if we look at here, solar versus coal, what do you have going on here, Sam?
Definitely. So we like to talk about how solar stocks were the best thing to own during the last presidential term, which was a Republican, and that kind of goes against what you'd think. You think Democrats are good for solar because they're subsidizing it, etc. But it was the exact opposite. And you saw solar go up to over 2,000% in 2 years relative to coal. And that relationship turned and gave back all of that. and today we're sitting at the same level where this 2,000% move started back in late 2018. Um, and I included the RSI. We're seeing a pretty significant bullish RSI divergence. Again, signaling that maybe this relationship's going to start trending in the opposite direction. And we've seen like First Solar like had a huge move a couple weeks ago. We're seeing some of the smaller solar names signal that potentially they could be done falling and reversing trend. Yeah, what do you think?
No, I like that. I like the idea here, and I think it's really interesting because if you go back to 2019, 2018, 2019, for example, I remember, having these solar trades coming up. And the people always like, it's funny because I remember we had all these solar trades on in 2019. I think even in 2020, we were long solar too. And I remember it was November 2020. I started buying energy pretty heavily. There was oil, the energy sector futures, which is the IXE, what else did I buy? Basically heating oil, gasoline. Like I'm acting like, what else did I buy? It was like everything.
It was the whole complex.
Yeah, the whole complex was giving signals at that time, including natural gas. And I remember one of our clients just got very upset with me. Like I thought we were a solar fund and we were doing things to save the planet. And I was like, I'm just buying what's in uptrends and downtrends. Like I have never disclosed to anybody that we were a solar fund or a green energy fund. So it's kind of funny to think about things like that when you are a trader. Is like, you have to think about it. One, if solar is moving down against coal, like there's nothing wrong with buying coal stocks. Not to mention, one thing people don't really think about is if you're doing something like you have a coal company, whether you like coal or don't like coal, most people really do like electric cars. Well, how do electric cars get charged? Well, most of the time it's on coal energy in the United States. That's still our main producer of energy and electric. So we still have to these companies are still profitable. They're not just dead dinosaur companies. They do have a future ahead of them. And if we look at, solar, yes, there's a future there too, but that doesn't mean that it's going to be perfect. It's kind of like when people think of Bitcoin. Bitcoin, any of the altcoins. Bitcoin's, it mainly goes up over time. But think about the altcoins. Some people have huge ideas with the altcoins. And I'm not saying the blockchain is dead or the blockchain is stupid or anything like that. I'm just saying that there's a possibility of these things going in downtrends for long periods of time and then back into uptrends for long periods of time. And as traders, that's our job. Our job isn't to really think about it more than let's put on the trade. Let's see where which market is outperforming. And also another thing to talk about, and the reason why we use these signals and why they're so important. When you have something like solar and it is going up against coal, like we talked about in 2019, 2020, we want to be long the thing that's outperforming. And the reason why is, and there's two things. We'd look at solar versus coal. Okay, now it's in an uptrend. Then we'd look at the S&P 500 versus solar, both in uptrends. And our goal in that is to outperform the market. Because at the end of the day, if you're not outperforming the market, you might as well put your money into the S&P 500 ETF or some retirement fund and walk away. So by taking these little things of intermarket analysis, like Sam's done here, grabbing the solar, doing it against coal, we know something. And then getting into the interesting one that he brought up, which is the Democrats versus the Republicans. And here's another thing that's kind of funny to talk about with that. November 2020, there was a ton of articles, and it actually in my Against All Odds research, it's aaoresearch.com. I don't really use that page anymore for anything, but it hosts all of my old blog stuff. And because it hosts all of my old blogs, it has the news articles from around that time. And I kept laughing about the fact that energy, supposedly, if Biden won, you were supposed to buy more solar. You were supposed to buy technology, semiconductors, basically anything that was going to be AI focused. And if Trump, not even AI focused, just basically anything, anything that was tech focused for the most part, and green energy. And then if Trump won, you were supposed to buy financials, banks, and so on. And then for the next year, financials and banks were the outperformers, and technology even fell off a little bit, and solar and semiconductors even underperformed, and solar absolutely underperformed. So it's quite interesting to kind of think about markets through that lens, where it's sometimes it's the opposite of what you think. And how do you know that? Because you can't just be a contrarian and go, well, these news articles always are wrong. You have to look at it and go, how do I create a system or signal to do this day after day consistently? And that would be by using something like this, like an intermarket analysis model.
For sure, yeah. Um, and it's okay to be contrarian, I think.
For
Um,
sure.
but you definitely need to have the market confirm your opinion. Um, Otherwise, it's gonna lose you a fortune. And the market's designed to fool the majority. So maybe you're not the only one thinking like this. Uh, it's
Yes.
important to remove your ego from it and just follow the charts.
Yes, exactly. And I completely agree with that. It's you have to just follow the charts. And it's good to have your own opinions and things, but you have to have the market confirm. A great book, on that subject is Reminiscences of Stock Operator. You pay a premium for the market to confirm what you're thinking. And that means that sometimes I think the hardest thing for people to do, and the reason why most people lose money in markets, is they like to buy things on sale. It's crashing, I'm buying, this makes sense. Really, at the end of the day, it's actually easier to buy things that are moving up. And even people always say things like, yeah, all the stupid people are buying the new highs and stuff. And it's like, I don't know if that's the stupid thing. If the majority of people buy lows and try to buy things as they're crashing, and other people are trying to buy highs when nobody else really would buy that, that's probably the people who are making money. And I think that more people, if they shifted their mindset to buy breakouts, or like at least waiting for it to get over a moving average. I'll watch all these people just buy things. Oh, it's at the 200, it's lower than the 200-week moving average. It's never going to be down here again. I got to buy, like, things like that. Usually one they usually chop around for a long time. Things that crash chop around like crazy. They're going to go sideways as long as you could ever think. Um, that makes perfect sense. So, and then you're going to get mad and you're going to be like, I got to get out of this trade. So you're going to be in this choppy trade. It crashes. It goes sideways. It's completely normal. I mean, look at this chart. It's a perfect example of it. 2022, it hits a top. It crashes. It then goes sideways for a whole year. It looks like a year, maybe longer. Most people wouldn't hang on to that trade and go, hey, it was cool, I bought the bottom. It would chop around sideways, and you could have really waited for that breakout zone that happened in late 23 to those highs. So what do you got going on here on this chart, Sam?
Definitely, yes. We've been noticing an interesting bifurcation in the coal markets where the coking names are not looking so good, and the thermal names are continuing to chug along. And I went in and made a custom index of both the coking coal and the thermal coal stocks and looked at the relationship. And sure enough, it's a pretty common thing to see bifurcation between these two groups. And you get some pretty dramatic swings. Like in 22, it peaked and fell 50% or so. And then you got a year of sideways, then it ripped higher, the opposite direction, over 50%. And here we are going back down, making new 6-month lows. Um, and I can't tell you much about the fundamental reasons about coking and thermal coal, but there seems to be something there.
Yeah, I mean, it doesn't. At the end of the day, it doesn't matter. That's a thing.
Right.
Like, yes, there are reasons, and like I'll have these conversations with people. I understand the fundamentals on most of these things pretty deeply, but I'll say most of the time I don't really know. I'll have the conversation, but I had the conversation about cocoa for probably a year and a half just because it was so crazy. Cocoa, why is it up here? I have no idea. We're long. Well, why would you stay long if you have no idea? Because it's in an uptrend. Like, that's really the truth. And yes, I could say there's a million reasons, from the trees to the cocoa production to supply to the cocoa war situation, which I've written about a million times. There's all of these reasons, but at the end of the day, the reasons don't make the price go up or down. It's kind of like when you look at something like CPI report. You have a CPI report come out. Most of the time, like, you don't really know exact. Like, sure, like you could say, hey, we're in this economic regime right now where everybody's watching the Fed going, okay, they're going to cut rates. And when the CPI data comes out, it should make the market go up. But if you go back to, let's go back all the way to when we were like wishing they would stop raising rates. And this is back in October 2022. If you look at a chart of that, you can see a huge candle the day of that CPI report. This is when everybody's watching it going, okay, we need inflation to come down because then the Fed's finally going to stop raising rates. We have the worst CPI report ever at that point. Worst CPI report of the year. Probably of the cycle, maybe. And the market bottoms right at that point. It reverses, it goes higher, So basically, there's a lot of things that go into markets. One of the things is positioning. Positioning is incredibly important because when every single person is short, who's left to sell? There's nobody. And so, like, think about it like, on a boat. So you have everybody on one side of the boat, and let's say the boat's about to tip over. There's nothing you can do at that point except for go to the other side of the boat. Do you want to survive? You go to the other side of the boat. So at that point, there's no one left to sell. And that's what creates. Most people think of markets in a very different way, where they think of markets as like everybody's excited, it's going to go up. The more people long, the better. But really, it's if something's going up and it's at $2,000 and everybody's already in, it's not going to go up anymore because who's left to buy? So it's the same thing on the downside. So the CPI report, the positioning was completely offsides. The market goes right back up. It's a great thing to think about because it's the same with earnings, economic data, anything. But you can learn a lot from understanding that failure event. Meaning, when we have a failed breakdown like we had in October 2022, that was the absolute low in the market. So that was a shift in the news, shift in the mindset of traders, and the market continued up for till now. It's still moving up. So I think it's great that you said that, and I'm glad to kind of have the conversation of understanding what's important about releases and reports and fundamentals, because it's not that they don't matter, it's that they do matter, but something else that matters is understanding when something has a reversal and a news failure event or a fundamental failure event. That means the market participants are very different, and positioning as traders and using technical analysis or COT reports, you can kind of see that positioning and kind of position yourself accordingly. Everybody was short at that point. Everybody, I mean, you read the reports. If you go to the CPIs or COT reports or anything, you'll see that everybody was short at that point. It's the same with the election in 2020. That's another thing we could talk about too. I don't know if you look into that much, but something that's kind of interesting to think about. 2020, same exact situation. Everybody was short. It was going to be the end of the world if Trump got in office. We're all going to die. If Biden got in office, it's going to be the end of the world. We were all going to die. And then next thing you know, everybody's short, and then the market just skyrockets and doesn't turn back till now once again. So it's kind of interesting to think of all those factors.
Definitely, yeah. It's not often you get a bottom like you did in 2022. That one really hit you in the face.
Yeah.
It was pretty clear.
Yeah, very clear. And I think it's funny to kind of look back at it and go, and I think that's the thing that not enough traders do, is look back and go, shit, this happened. and what would I have done differently? How do I do differently this time? Because I think that 2016 election, you had so many people do the same thing, and like people, and that's a thing when people go, well, if everybody knows something, and then the market's not going to do it. It's like, well, there is that fact, right? That is a truth, but also I feel like people continue to do the same thing over and over again. So that part of it is absolutely true, but people continue to do the same thing over and over again. Why is it almost every single election the market skyrockets right after, and usually doesn't look back? There's probably one or two that it did look back, but there's still a 2-month rally to end the year anyways. So go back to 2008. There was a 2-month rally still, massive rally after the election to end the year. It's just people kind of make the same movements over and over again. I'm not saying like, hey, this election's going to go perfectly that way again. I don't know. I could be completely wrong. But I think the probabilities are that volatility falls off after the election and the market goes up for another month or so.
Definitely, yes. We have the data. We've
Yes.
been having these elections for a long time.
Long time.
It's been
Almost
repeating itself. Yes.
So what do we got here? Small cap discretionary to staples, and then large cap discretionary to staples.
Definitely, yeah. This is one of our favorite intermarket relationships when um, trying to get a gauge for risk appetite in the equities markets. Are you looking to buy discretionary or staples? Staples are defensive, so we want to see this ratio going up and to the right. Um, and we've seen an interesting divergence between the large cap and the small cap discretionary versus staples ratio as of late. And I know that the large cap is driven by just a few stocks, like Tesla comes to mind. Tesla has been struggling. It's been catching a bid here with some news out of the way, but that's been keeping this ratio trending lower this year. Um, and we've seen some interesting divergences in the past. Like in late 21, we saw the large cap make a new high, and then the small cap did not confirm that. And sure enough, we ended up going lower. So I think the small caps could have it right here. Uh,
I agree. I think this is a really cool chart, and I don't know if I've ever seen it drawn up like this before. And generally, like when you look at the market and understand like what type of environment it's in, like you have here, like it's in an environment where the large caps are telling, or the small caps are telling the truth. Um, and most of the time, like you said, like the large cap is so driven by just a couple names that you can't really get anything real out of it. So I really like this chart, and I completely agree. I really have no reasons to be bearish yet. Besides, it's summer and we're probably going to chop around and people are going to get annoyed. That's the only thing I can think of. And generally, like I think something that's important to do as a trader is to be aware of those seasonality things. Not that you trade on seasonals and go, okay, this is going to work perfectly because I looked at my seasonal chart. Think about it in a way where you go, okay, it's summer. The market's going to be choppy. I need to manage my expectations. What might go up right now? Maybe oil, maybe my energy trades will do well right now. Maybe they'll turn around and turn back up. I don't know. But other than that, if you're in stocks, like you're probably going to get chopped around. There's a nice rally that happens in July sometimes. That's about it. But besides that, you're going to get chopped around, and especially September, you're going to probably see a lot of volatility. So I like the way this chart is. Let's go. What do you got next here? So equal weight Amazon of XYZ country index.
this is an interesting one, yes. In bull markets, you see these internet retail stocks do tremendously well. It's a great sign of risk appetite in the markets and a strong economy. Um, and we're seeing a lot of these Amazon of various countries make new highs. Like the Turkish Amazon um, is breaking out of a nice base, and this index I made is making new 2-year highs after a pretty textbook basing pattern.
So what does
Looks
this
ready to make a
index
new.
consist of?
Um, it has, I think, 12 stocks. Um, just there's more than 12 of them, but over I think I've used a market cap threshold of 500 million. But it has like Mercado Libre, the Amazon of Latin America, Coupang, uh, the Amazon of South Korea. Um, there's some of the Chinese Amazons in there, etc. And like if you look at the Amazon, Amazon.com, it's right there at a shelf of former highs. Looks like it could break out to all-time highs soon. I
No,
think
I
this
like
is
this.
a great indication of risk appetite in the markets,
No, I
equity
like
markets to be specific.
this is really cool, and I really like this index because really like when you that's part of the reason why I wanted to have you on, because you have all these very creative indexes. And I guess another question to ask is, how do you come up with these things? Because you really have a good sense of figuring it out, looking into it, and so I know for me it's a lot of trial and error, coming up with things. Oh, that works. Oh, that doesn't work. So what how do you come up with these things?
Um, we see interesting things in the market, and then we go look. Is there an ETF for all of these internet retail? There's some of them, but they consist of things we don't really like. So we kind of make our own rules and um, get the information that we want because there's not always ETFs to give you the information that you're looking for. Um, and a lot of the time, it's a dud and it's a waste of time. But sometimes you get really valuable information. Like this is very valuable to me.
No, I absolutely agree. And when you can figure out things that are like, you can put into your trading that will help you to become a better trader, help you to find trends, see relative strength. I think that's the thing that's really cool about this is, you can kind of see where the market started to turn up really, where it bottomed, where it struggled. That's the thing that I think is the most interesting about this chart is that it's topping and it's hitting resistance right around all the times that the market started to struggle a little bit. So that's another great piece of this. That's kind of a good indicator. So let's go to the next one. This is a really cool one. Crude oil versus heating oil. So you have the heating oil, which is basically kind of like diesel. When we talk about heating oil, we mainly say it's very similar to diesel. So what are you seeing here on this chart?
Definitely, heating oil it's used a lot in like trucking and a lot of factories use diesel. So it's very leveraged to industrials, and this is kind of telling me that industrials are doing good potentially, as the heating oil could catch higher relative to crude oil. And this chart it has a nice bearish divergence on the RSI, as well as sitting at a shelf of former resistance. I think it could be a tipping point for this ratio potentially. And this to me is risk on for the economy, um, as it doesn't really get much more uh, risk on than industrials and truckers
Yeah.
and things like that.
No, I agree, and it's a cool chart too. And like one thing that I noticed initially looking at it, which is you have crude, which when it was making its kind of these bottoms or tops, crude almost seems like when heating oil is kind of leading the way, it's usually at its strongest, is what most people would teach. However, it kind of looks the opposite here. And that's the kind of thing that's really cool about intermarket analysis and seasonals and everything is like you'll talk to people and they'll say, well, it's this driving season is just starting up and now it's the winter, so nobody's driving, so it doesn't matter. And that's why crude oil is doing bad. And if you look at it, you go actually crude oil's best month of the year is February. If you can go back as far as you can, you basically see that it has a massive bullish tilt in February, same with heating oil and so on. We start to get in a little bit of a bullish tilt now in June. Once again, the other thing you have to understand is, production rates and refining rates and all of these things and when they pick up. So if you have, a low supply in a period that's winter, that can also create oil moving up into a strong uptrend. I'm looking at this here too, is seeing, it's kind of saying crude oil down to heating oil going forward. So what are you thinking, going forward in just the energy sector as a whole?
Yeah, it seems to be struggling. Like XLE still can't make a decisive upside resolution from this massive base. That stands out to me. I have an RRG later showing that energy is struggling. Like crude oil, I also included the crude oil relative to gold. That's making new 3-year lows. It seems to be a tough time for it. And to go back to it being an election year, maybe there's some shenanigans going on there.
I think that's kind of an interesting to say too, because the one thing that I was talking to Ian about it the other day, and I went on my buddy Kashop. He made a post that I was tagged in that was talking about oil and how there was a conspiracy on there about Bloomberg and them basically putting bearish information out on oil. And I was like, well, that sounds crazy. I really doubt that's the truth. But I started to look into it because I was curious what exactly he meant, because he tied it into some political thing. And I tried to just take that political part out of it and go, well, what's true here? Is there any truth in this? And so I went out and I dug through all these different articles and I tried to find, where these bearish articles were. And I did see a bunch of them. And then I was like, okay, well, why are they saying this about OPEC when I read the OPEC report and it's different? So I went to the Economic Times, other places to just kind of make sure I wasn't reading it wrong, and I wasn't. And so it was like they are kind of using a kind of bearish tilt towards it. It doesn't mean there's something nefarious going on. That could even be something like, hey, there's somebody who writes for Bloomberg and then they're copying from him, and that's turning into all this. But either way, you're seeing a lot more. The fundamentals aren't incredibly bullish by any means, but they're also not incredibly bearish. The price would be right a little bit above this, for basically the refiners, for the producers, for everybody. But we're kind of seeing this kind of bearish tilt come out from the media. So I think part of it is that the Fed really needs oil to come down to finally be like, okay, we can lower rates. And I think that just is going to be what they're thinking. However, I think that comes into another part of this conversation, which is if the Fed lowers rates, or even really, like they're kind of talking about it right now, but if they give a definitive September and we start to get closer there and we see this rate cut coming, I think inflation is going to skyrocket. It's right under the surface still. I don't see any reasons to go, hey, it's dead. We have enough room now where we can lower rates. They're going to do it. It's not that they're not going to do it. They're probably going to do it at some point, probably once this year at the very least. And that if that happens, I think we're in a situation where inflation's going to come roaring back. The only way I see it making any sense is this. If we get into the middle of this year or later this year, let's say September even, and we see an actual crash in the market in August or September, and then oil and then everything kind of comes down, that would be the only scenario I would say where they would be clear to do that. But I still think that ends up, like, my biggest thought right now is I don't know exactly what type of turbulence we're going to see going forward. Are we going to see turbulence like the market moves down and then commodities move up? Or do we see it where commodities are right here and then they move up? That's the only two scenarios I see. I don't see a scenario where commodities just go back to, 2000 level, and next thing you know, oil is the $40 a barrel. I'd be incredibly surprised at that.
Definitely. What comes to my mind is the over 40 years of a bull market in bonds ended just several years ago. And these trends tend to persist for a very, very long time. So in my mind, it's not going away. It, we will have changes in the short term, but the long-term trend for inflation and commodities, in my mind, is up.
I agree, and I think it's the same thing when I get into conversations with people are like, "Oh my God, you hate bonds so much," and I'm like, I'm not saying that there's not a possibility, and that exactly what you're saying. Neither one of us are saying that there's not a possibility that bonds start to move up again. I think it's very likely that we see retracement rallies in bonds. What I am saying is we will probably never see a new high in bonds for the next 40 years. And that's likely. Really, my call, I usually say 10 years or to the end of the decade or something, but really, I really believe it'll be more like 20, 30 years. Just because that's how the cycle works. It's not because I'm trying to guess or predict. I'm just saying, like, the cycle for bonds is usually very similar. We see slight upticks in inflation until we see a blow off top in inflation. And I don't know when that's going to happen. The US, for many reasons, it would be very hard for them to go to negative rates. So, I mean, really, like, it's not that crazy of a prediction to say, hey, we're not going to go to under zero again. Like, I'm not making a huge call here. We're just saying it's very possible that the bonds stay in the normal cycle. We'll see some retracement rallies, meaning some form of disinflation in the middle of this massive inflationary cycle. But the trend for inflation is probably higher and probably continues to be higher.
Definitely. We've seen foreign countries also stop buying U.S. bonds, which is a big deal to me. Buying gold instead. Who's going to buy these bonds?
Yes, exactly. That's a good point, and it's really, really true. Who's going to buy these bonds? Why would you buy bonds? Are the only people really buying bonds heavily right now are retail people, retirements, grandmas, like that's the people who are buying bonds. For the most part, it's just those people, and anybody who kind of understands the cycle. You wouldn't want to be in bonds for 20, 30 years. You can trade them. I'm not saying there's not trades to come. Even the short end of the curve, I don't think there's anything wrong trying to buy the 2-year to euro dollar futures. They call it, it's a different name for it now, but I grew up I'm too old, I guess. But basically, you have the front end of the curve, which is anything from 3 months. I mean, it even goes to 1 month, but 3 month to 2-year bonds probably are fine to buy right now. You could make a good yield. You can have probably a good rally out of it will come when the Fed starts to cut rates a little bit. The long end for a 60-40 portfolio, I think that's insane. Like, holding that for 20 years, I think that's insane. You're just going to continue to lose money. But what's interesting is I ran into a guy at the event in Sonoma, and he had a really cool article that he was talking about, which was called Pavlov's New Dog. And it was the idea that people will not learn that bonds are probably not the thing to buy for a while. People will probably continue to just buy them, think it's the way to do it, because they've been right since 1982. And they've been wrong only in the last 4 years. So I think people will continue to go, well, I think I should buy these soon. I think it's going to go up again soon. And really, there'll be retracement rallies. There'll be something that's going on. But those years of, I just put my money away, I get 10% per year in bonds or 5% per year in bonds, it's just not going to happen.
Yeah, for sure.
So we got crude oil here, speaking of bonds.
Yes, this is a good one. The relationship between crude oil and gold.
Mhm.
In energy bull markets, you see crude oil go up relative to gold. We saw that from the low in 2020 and until the middle of 2022. Um, and today that has reversed as the ratio is making new 3-year lows. And you look at crude oil priced in dollars, hasn't rolled over yet. It's held this level.
Mhm.
Um, but in my mind, that's a denominator fallacy. Crude
And in
oil is weak.
gold, or in crude oil to gold, like we did see that breakdown signal happen a little while ago. But what's kind of interesting that you're pointing to here is, that possibly a false breakdown. Um, and I didn't think about that yet. That's something that I haven't really. I look at that chart a lot, but I didn't look at it very recently. And kind of seeing that it's retraced a little bit lately and is trying to break back up to the upside is something that's kind of interesting. Something to keep an eye on.
Definitely.
Every breakdown or breakout always retraces. This is why people hate trading breakouts and breakdowns. However, like most of the time, they do go in the way of the underlying trend. But if we started to get over that right shoulder area, like that's going to really say something. So you get over that right shoulder, that's possibly saying that oil's now taking over again.
Definitely. That would be incredibly bullish.
Gold, and something that's interesting that I didn't think about yet, that's something that I'm going to have to do some research on, is I do the gold and oil, basically gold kind of signaling that oil is going to move up soon when gold starts to be the outperformer. However, looking at this, I wonder if I should look at that ratio together like this, because this is kind of giving you the, hey, gold is actually started to outperform early 2022. And basically in early 2022, that started to outperform. And if we actually got to these lows and started to retrace here, that would actually be the right time frame for how this cycle usually works with gold leading. It would be spot on. So if actually oil started to move back up here, uh, it would be a very spot on, very normal signal to happen that gold kind of hit the dinner bell, and now crude oil starts to move up. Now, once
Definitely.
again, it's the same thing that you and I are talking about all day, which is we don't know exactly when that's going to happen. There's two different scenarios building here. And as traders, it's important to always have two different views, two different outlooks, because you want to be able to get out of something once you're in it. So I really like this chart. This is cool. I'm going to have to do some work. So
Cool.
another good one, crude oil to natural gas.
Yes, this is hitting a massive level of resistance. It, it reacted to it, and it's making new multi-month lows. That is like the heating oil chart we were talking about before. It's it speaks to the economy in my mind. Natural gas heats a lot of houses, and this is one of the more seasonally bullish times for natural gas, right? With
Yes.
the summer heating homes, so it's logical. Um, what do you think about this chart?
I mean, it's very interesting, and one that natural gas is such a natural gas is one of the toughest products to trade, and it's not because it's hard to trade more than it's just very volatile. You have to have a very small position to trade it. This thing, like I just think about the position. We're long natural gas right now, and I think about the position. It's if I go back every week, I go back through each day of the trade. I don't look at it every day, because if I look at it every day, I'm going to do something stupid. So I just look at it each day of the trade, and I go, okay, the volatility for this last week it was up like 5%, it was down like 3% the next day, it was up 6%, it's down 5% or 6% the next day. Like it's just how it works. So like the people who try to trade it and they use a 5% stop, like you're never going to make any money trading that. Same with, even if you're, especially in my time frame, I'm in a longer time frame. I have to have an even wider stop than most people. So, me running a 20 something percent trailing stop is completely normal on something like natural gas. However, that just me, because people go, wow, that's very big. Well, it's not big if you size it right. If your position is, if you have $100,000 portfolio, just to make it an easy number, and your position in natural gas is only $5,000 of that portfolio, and to hit your stop is, let's say it's $1,000 for 20%, you're still only losing $1,000 in your portfolio. Yes, if you try to trade $100,000 in your $100,000 portfolio, and you're trying to put that stop at 20% still, yeah, that's 20K. So that becomes a lot of money. So you just kind of have to really understand your sizing as trading. But getting into the actual movement of this and what this chart's saying, I think there's a bunch of different things we can read into this. One is, if we look at crude oil, and let's go to, does that chart have the 2018? Yep, that big crash right in the middle is 2018. So something that people don't know about natural gas is that it does whatever it wants. It is not correlated with the S&P 500. It's not really correlated with oil. It's not correlated with anything. It does whatever it wants. And the best example of this was when somebody thought they predicted what natural gas does for eternity. It was called the optionsellers.com. So the guy had a company, it was a fund called Option Sellers. And so Option Sellers, basically their strategy was to sell naked puts on oil. So as oil went up, they were making all this money. They're making money for years. They started like in 2015, I think, when oil bottomed, and they were just making all the money in the world. And then natural gas was in this perpetual downtrend for years. And so they're selling naked calls on natural gas, and they're making money for years once again. And they look like geniuses. And then basically 2018 happens. It's October 2018. Natural gas goes straight up. Crude oil goes straight down, and they blow up their fund. And this guy, I mean, it's a sad story, but it's a cautionary tale. Like the guy's literally like, I'm sure you could find the video. I think he took it off YouTube, but it's still out there in places. But if you haven't seen the video, he gets on there and he goes, "I'm sorry, Tom. We lost all your money. Your wife made great pizza or something." Like they would send him gifts and stuff. And it's a really sad story, but that's just one way to look at it and just go, okay, natural gas is whatever it wants. So start there. And then when you look at where this is kind of topping and you go, okay, crude oil had this massive outperformance compared to natural gas since, 2023, 2022?
2022.
Yeah, 2022. So it has this massive outperformance since 2022. And then natural gas has a little bit of a move back, and then it moves back up. However, natural gas has been taking a major hit since 2022. Just kind of moved straight down, never caught a bid. So I think more what I would think here is a possibility of natural gas leading the way, more than I think that crude oil is going to crash and natural gas is going to move up. So I think natural gas will probably lead the way. It's probably the winner out of these two. It gave there's two things about natural gas, and even though like I don't look at fundamentals, especially as like cheap or expensive levels, I do see that natural gas can get to a point where it doesn't make any sense anymore for it to be as low as it was. So we got all the way to that level. We were sitting at this major low in natural gas. It didn't make any sense anymore. People started to bid it up. It's still because what you have to think about is, are the companies able to make money selling it for the price they are? Is it worth it to get it out of the ground anymore, and so on? And once you figure out those numbers, you could still say, well, there's a lot more upside to go. However, as a trader, I'm just sitting there in this trend and just going, okay, it's an uptrend. I have a very wide stop. I'm going to sit on my hands and we'll see where it goes.
Definitely.
So you got time for another chart. Is there anything specific you want to go through?
Let's see. I think slide 9. That's
Is
a good
that
one.
2 up from here?
Yeah, this one. Yeah,
This
so this is the bellwethers of energy. You've got the
one.
largest oil and gas, the largest solar, the largest coal, the largest uranium. This looks a lot better than some of the indexes out there.
Yeah.
So if you just stick to the big boys, you're making all-time highs.
I like that because that's I think it's a messed up way to look at things where people are so interested all the time in the smallest names. Like, yes, you can have those very cool trades that you can tell your grandkids about in 30 years where something skyrockets and you're like, oh, cool, I was in GameStop. Like it all sounds very cool. However, do you want to make money or not? Like, if you want to make money, you want to probably be in the big names that aren't going anywhere. I like to be in the biggest names, but also trade through sectors, find different sectors to be in and so on. But I love this index because it's just so easy to understand and it's something that just most people don't do. But I like this. So, I mean, even the energy you have, is this mainly, yeah, equal weight energy names. So any of the large cap energy names, you even have, is that CCJ in there? Yep. You got
Yeah,
CCJ.
there's
So that's a uranium
uranium, there's
miner.
coal, there's solar,
Yeah.
all the energy. Yeah.
No, I love that because it's literally perfect to kind of put that together in a way that people can kind of understand, especially like when people talk about ETFs, they go ETFs suck. And really ETFs are great, but the only reason why they're great is because of those large names inside of them. When Apple takes over the XLK, it's great. When Microsoft takes over the XLK, it's great. And you get a little bit more diversification than just buying one or the other. And then if you look at this index, it's like you're making new highs in sectors that nobody's talking about, nobody cares about, and that are actually kind of underwater at certain times. Energy is a little bit underwater right now, but this is somewhere to kind of pay attention to and go, well, if I'm going to buy energy, I want to be in the largest names. If I'm going to buy uranium, I want to, and that's the damn truth. And uranium, especially, like either you buy the ETF or you buy CCJ or nothing. Like there's people, I have a friend who does this and he's very good at it. Kashab, he can find those names. He's very good at them. I have no idea how to do that. I feel like I always lose money trying to figure that stuff out, whether it's technically systematic, whatever it is. It's very hard to do.
We like to use relative strength. If you just take the chart of the equity you're interested in and benchmark it to its peers, benchmark it to the broader market, and you just go through a whole bunch of charts, it stands out very clearly what the winners are.
Yeah, I mean it's this. It's yes, you can do that. Yes, you can find small cap names like that. It's more that it's very hard to stay in those trends. It's very hard to, there's more headwinds when you're trading the smaller names. You can trade them, you can make money doing it, but the safest bet is to use these biggest names. That's where you're going to get the smoothest trends.
Yeah, absolutely.
So cool. Did have a comment / compliment for you. Solar and wind are not commodities, so it's interesting to compare them.
Just think of them as energy. That's how
yeah. So I mean, it's what was that first chart you did that we did? I can't remember.
The solar versus coal.
Solar versus coal. Okay. So what we're comparing here is
the dirtiest energy versus clean energy.
Yes, we're comparing sectors here. We're not exactly comparing solar energy versus coal. We're comparing solar stocks versus coal stocks. So the solar sector, there, if you look at the TAN ETF, you can go through the names inside of there. First Solar, I think, is the biggest still. And then coal, you could go inside of there. I think tech is probably the biggest still. So basically comparing these names back and forth will kind of tell us where these sectors are headed. what's moving up, what's moving down. What he's kind of pointing to here is that there's a possibility that solar starts to take over again. So, yeah, so he's kind of getting in a conversation about solar and wind, but that's not exactly what we're trying to do here. So, all right, Sam, thanks so much for coming on, man. Really appreciate you. This is a lot of fun. Anytime you have some new charts, man, please hit me up. Come on, we'll chat about them. It's a lot of fun to just chat some actual like cool intermarket ideas that, especially some things that I haven't seen before. So I've been seeing a lot of stuff for a long time, so it's cool to see some stuff like that.
Definitely, Jason. Thanks for having me. And not a lot of people appreciate my intermarket charts like you do.
Cool, man.
It's cool to chat with you.
Of course, man. Well, you take it easy, Sam.
Thanks, Jason.